Welcome back, everyone. Let's jump right into today's explainer because we're breaking down a massive macroeconomic event that literally hasn't happened in almost 80 years. We are looking straight at the unprecedented 2026 dual-power Federal Reserve. Think of it like two captains trying to steer a single gigantic cargo ship in completely opposite directions right in the middle of a hurricane. But more importantly, we're going to lay out the exact fixed income strategy you need to extract alpha from this coming policy civil war. We're cutting through all the noise today to understand how the very mechanics of central banking are shifting right beneath our feet.
So, it's a pretty stark question, isn't it? What actually happens when the world's most powerful bank goes to war with itself? There's this pervasive myth out there in retail trading that the Federal Reserve operates as this perfectly unified monolith, just smoothly pulling the levers of the global economy with zero internal friction. But the brutal truth about 2026 is that if you're using standard playbooks from 2025, you're walking into a massive trap. We're entering an era of deep institutional conflict. And look, if you're still just trading the headline interest rate, you are completely missing the real driver of market volatility right now.
Okay, let's dive into this with a little historical context. 1948. That was the absolute last time an outgoing Federal Reserve chair refused to leave their board seat. Back then, it was Mariner Eccles. He stayed on as a governor after President Truman denied him reappointment. Truman was under intense political pressure after World War II regarding inflation and interest rates, and Eccles essentially just stayed in his seat, fighting as a shadow chair to protect central bank independence from the administration. Fast forward to today, and we are seeing this exact, incredibly rare scenario repeating itself with Jerome Powell and the incoming chair, Kevin Warsh.
Here's our roadmap for today's explainer. We'll start with two kings at the Fed, move into the anatomy of dissent, break down the tail of the tape, look at deficits and duration risk, and finally, we'll map out the shadow chair alpha.
Starting with Section 1, Two Kings at the Fed and the End of the Monolithic Central Bank. As you can see from this quote, we are officially operating in a dual-power environment. Here is the neutral reality of what's happening on the ground. Jerome Powell has chosen to stay on the board as a governor until his term expires in 2028. Basically, he's acting as a guard dog for institutional independence while the DOJ probes into Fed headquarters renovations. He wants to ensure a bright, uncompromised line between political influence and monetary policy to cement his legacy. But simultaneously, Kevin Warsh enters the chairmanship after a super tight 13-11 Senate Banking Committee vote, and he's armed with a very clear mandate for regime change. So we've got two incredibly powerful figures operating with two totally different mandates, occupying the exact same building.
And while retail investors are out there cheering the S&P 500 for breaking that historic 7,000 barrier, institutional desks, they're seeing a very different, much more precarious picture. That 7,000 level is a fragile milestone. It's built on old liquidity paradigms. The big institutional players are actively bracing for what they call the independence tax. They know for a fact that the primary driver of market pricing going forward isn't just your standard CPI and PCE inflation data anymore. No, it's governance friction and born dissent.
Which brings us to Section 2, the anatomy of dissent with any fractured committee.
Now, what's really interesting about this slide is the explicit breakdown of the 8-4 split from the April 2026 FOMC meeting. Just to put this into perspective for you, historically, FOMC decisions are almost always unanimous. Maybe, just maybe, you get one token dissenter. 4 dissenters? That is an absolute rebellion, literally the highest number of dissents since 1992. As you can see, 3 distinct camps are forming. You've got administration doves like Stephen Mirren pushing for immediate cuts. You've got institutional neutrals like Jerome Powell holding steady just to protect independence. And then you have this firewall of regional hawks like Neil Kashkari demanding we hold rates because 3.3% inflation is getting too entrenched. Kevin Warsh is inheriting a deeply fractured room. Building a unified 12-member consensus for his regime change is going to be practically impossible.
All right, moving to Section 3, the tail of the tape, Warsh versus Powell.
And this brilliantly illustrates the core macroeconomic conflict here. Kevin Warsh believes heavily in an AI-linked productivity miracle that naturally dampens inflation, which in his mind allows for lower interest rates. But crucially, he also wants to aggressively shrink the Fed's $6.7 trillion balance sheet and move toward a scarce reserves model. Let's break that down real quick. Scarce reserves essentially means aggressively draining liquidity from the financial system. It forces the interbank lending market to stand on its own 2 feet without a massive central bank backstop. It's a total high-wire act. Jerome Powell, on the flip side, represents traditional data dependency. He operates on an ample reserves framework, meaning he wants to keep a large balance sheet to ensure system stability. And he's maintaining a steady, hawkish stance until core inflation definitively hits that magic 2% target.
Let's look at Section 4, Deficits and Duration Risk, or what we call the $1.9 trillion trap.
Check out the historical lag between the federal funds rate and the 10-year Treasury yield right here. The macroeconomic headwinds that are agitating this internal Fed split, they are fierce right now. The U.S. is running a massive $1.9 trillion fiscal deficit for 2026. To put that into perspective, that is roughly 5.8% of our entire GDP. To attract enough capital to actually fund that avalanche of new Treasury issuance, the higher-for-longer reality isn't just a monetary policy choice anymore. It is a strict mathematical and fiscal necessity. If you're out there trying to simply buy the dip on long-duration bonds, expecting a quick return to the zero-interest rate era, you are walking blindfolded into a really deadly trap.
Let's move to the next piece and see how this builds, because compounding this entire trap is the utter failure of Treasury bonds to act as an automatic stabilizer. Historically, Treasury bonds act as a safe haven during periods of turmoil. But amid the Iran energy shock, which famously pushed crude to $100 a barrel, and rampant tariff uncertainty, this traditional correlation has entirely broken down. Instead of yields falling during a geopolitical crisis as capital floods to safety, we're actually seeing Treasury sell-offs with yields spiking. Long-term bonds are acting like risk assets right now, not safe havens. And a huge reason for that is the market actively pricing in that independence tax we talked about earlier.
Finally, Section 5. Here is the actionable part. The shadow chair alpha, trading the spread.
First up, we've got to understand the term premium. In plain English, this is just the extra yield you demand for taking on the risk of holding long-term debt. Right now, this term premium is acting purely as a governance tax. When you see the 10-year yield rising in 2026, it's signaling profound institutional fear and internal Fed dissent, not just standard inflation expectations. The market is basically demanding a higher premium because they simply don't know who holds the dominant hand at the central bank. That uncertainty itself is literally what you are being paid to hold.
So to actually trade this dynamic, we look directly at the 2-year, 10-year Treasury spread. Check out this timeline. At the start of 2026, we were sitting at a positive 69 basis points. By late April 2026, as the reality of Warsh's confirmation and Powell's flat-out refusal to leave fully hit the trading desks, it had compressed, hovering tightly around 52 to 54 basis points. The market was practically paralyzing itself trying to price in these competing agendas. This compression, this literal mathematical friction between current policy and future regime change, is exactly where the sophisticated alpha opportunity lies. So the crucial point here is the execution of a curve steepener trade. Let's walk through the step-by-step logic. Warsh eventually wants to cut short-term rates to support his mandate, right? That aggressively lowers the 2-year yield. But his desire for a really fast balance sheet runoff, combined with the dual power uncertainty and that massive $1.9 trillion deficit, forces the 10-year yield up. The short end drops, the long end spikes. So, step 1, you enter a steepener position when the spread dips below 50 basis points. Step 2, your technical stop loss kicks in if the curve moves back into inversion, because that means the Powell institutionalists have completely overridden the agenda due to spiking inflation. And step 3, your exit target is 100 basis points spread. Why 100? Well, historically, that's the exact level where the market is fully priced in a complete regime change. The Warsh premium is fully realized.
Now, beyond just the bond spread, you've got to structure your sector exposures to actually survive this policy collision. Here is your portfolio allocation logic. You want to overweight small caps because they are highly sensitive and will benefit the absolute most from Warsh's short-term rate cuts reducing their borrowing costs. Go heavy on financials, since traditional banks see massive net interest margin improvements when the yield curve steepens. In tech, you've got to be highly selective. Avoid expensive momentum stocks and focus purely on the AI infrastructure that's driving Warsh's actual productivity thesis. But, and this is absolutely crucial, because of the severe geopolitical risks acting as a backdrop to all this Fed drama, you must implement a robust gold hedge. Between the Iran shock and the institutional paralysis, analysts are currently targeting $5,000 an ounce as the ultimate flight to quality, tail risk safety play.
I want to leave you with this final provocative thought today. The era of the predictable, unified Federal Reserve, yeah, that is absolutely over. In this new era of dual-power monetary policy, are you still trying to just trade the headline interest rate, or are you ready to actually trade the governance friction? Understanding the structural mechanics we covered today really empowers you to stop reacting to the noise and start positioning yourself for the reality of the 2026 Civil War in policy. Thanks for joining me on this explainer. Stay focused out there, and I'll catch you next time.